Good morning, traders. It is Friday, September 26th. Lots of interesting things to cover from last night's update here. Lots of great feedback. Really appreciate everything and all the insights here. So after last night's update talking about trading versus gambling and just the overall update, just want to touch on a few of these comments here and we'll get into the markets. But Gorilla Trader talked about how he's bought 43 homes over the last 30 years. He's kind of had what he calls the cowboy phase, or I'm helping him mature out of the cowboy phase and excited about what we're doing here for consistent growth. And Gary talks about how he still has a bit of the cowboy phase stuck in him and some legacy positions that are stuck in the buy and hold, which, I mean, most of us have some of those from a long time ago. I did a big cleansing a few years ago, getting rid of penny stocks that were worthless and I'll just take the cash versus, letting that money sit dormant. So all of this stuff is normal. This is part of the process of cleansing and changing your styles and all of that stuff. And Gary talks about how he still has some money for playing the inner cowboy side, which we all have multiple accounts, I think. And of course, we do still play other stuff. And that's perfectly fine. We love trading. That's why we're here. But we also need to be smart with the majority of our capital, which is what this whole strategy is for. So a couple other questions here. We have one about sector rotation and what's going on with sector rotation. I can try and go into this deeper another time, but if we just go over to our sector, our hot list here, our band hot list, we're in this what I still believe is a stage 3 topping phase for the reasons I have mentioned many times before, but more or less in a stage 3 topping phase, sector rotation is all over the place. This whole board was green with risk on a week ago. And now half of the board is risk off. Money's starting to flow out of the stock market. It's not as healthy as people think it is. The longer term trends are still up because they take some time to change. Shorter term trends are still up. We're on the cusp of a lot of short term trends flipping down. But first we have money starting to flow out, and then the short-term trend turns down, and then we'll see the bullishness start to roll over to distribution or warning, or it'll start to sell off. So that what happens in a stage 3, which if I was to just pull up the market chart here and we look at a stage 3, what happens is sectors are hot for a week and then they fall out of favor and they pop and they drop all over the place. And it just makes it more difficult to trade. It's the same thing that happens in a stage 1. When the market's going sideways at a top or a bottom, it doesn't really matter. Sectors are they just have waves of being good and not so good. And again, one of the key things here is if we look at the Russell 2000 and just zoom back on the chart, Russell 2000 is, I know it's hard to see, but more or less we're coming up and we're putting in this, potential triple top here. Every time we see people get really, really bullish and we start to get FOMO, like I can feel right now in the market, and I can tell from people's comments, this is when small caps and micro caps usually do very well. Everybody's piling in, and just when they think, the next train is leaving the station or has left the station, it gets rejected and it hurts for people holding on. IWC is the micro cap one. This is one a lot of people don't pay attention to. It's pushing right up into the highs that we saw back in 2020, 2021. And again, people are just getting overly, I think, excited. Now, the market could take off. Who knows? There's a lot of stuff I think Trump is trying to do behind the scenes that could create a huge wave of quantitative easing and make the markets go higher and go insanely overvalued. But it really, at this point, it doesn't matter. We just follow price. If the market breaks through and starts to run and rips higher, maybe we kick back into a stage 2. But right now, the majority of stocks are slamming into resistance, major resistance. And the sentiment is also telling us people are really bullish. And that's usually not the best sign for the market. It's usually a sign of weakness. And just a quick reminder, almost 50% of you aren't subscribed to this channel and you watch it regularly. Just if you click the subscribe button, it's a way that I know you like the content that I'm doing. Again, post your comments so I know what I can improve on, what I can cover. I try to cover questions and reply to most comments as well. If you want access to my trading analysis, these videos are usually just general market analysis and some trading tips and ways to read the markets. And if you actually want my exact trades, my ETF trades, you can subscribe to my newsletter, thetechnicaltraders.com. The adaptive compounding strategy, that is what I focus on with my own portfolio, and I share those trades with you. We literally just grow our wealth together, trade for trade, throughout the year. So let's take a look at a couple more comments here. I think there was one for XLE. So we've been talking about how XLE could become an inverse play, meaning we play an inverse ETF as it falls. This person here, JC, is asking, you know, if we're in a stage 3 topping phase, precious metals usually do well and energy tends to do well. So why are we more or less looking for energy stocks as an inverse play? So that's a really good point. Let's just scroll down to the market cycles. So this blue cycle here is the stock market cycle. Usually precious metals do well. Energy does well. Industrial capital goods usually do fairly well. So let's just take a look. Obviously, we know precious metals are doing well. If we look at XLE, which let me just get rid of this one indicator for now. If we take a look at XLE, it's had a pretty nice push and a pretty nice run to the upside, and it might want to continue to push higher. And this is why we have to have rules. This is why we don't want to trade like a cowboy, even though, you know, I can see an opportunity brewing in this where energy has gone down for years and more or less oil stocks, energy stocks have gone up, which, you know, I think there's a lot of, everybody's just been jacking up prices of stuff to make profits. But overall, you know, oil prices have been going down. There's this huge divergence. I think we'll eventually see a huge reset in the energy space, but we don't do it until it actually starts. So for all we know, we could see the energy space move up even higher. And of course, that'll give us even more divergence, meaning energy stocks keep going up. Oil has been going down, which usually means less profits for these companies. And when things slow down, it's definitely going to catch up to these energy companies. So you're right. You don't want to step in front of this until it's telling us and the market is favorable to play the downside move. And this could continue to move higher. Obviously, lots of uncertainty, potential more stuff ramping up, which usually juices up oil and energy stocks. So yeah, don't step in front of this train. This train is still trying to figure out, you know, is it topping or what is it doing here? So if we take a look at another comment, so I was talking about trading versus gambling. How do you know when a trade is actually a gamble? A lot of people are putting on trades thinking they're trades, but really they're just gambling. They're looking for some action. So BR 5045 really found it really powerful. It was great timing yesterday. This person put on a trade. It felt kind of like a random trade, he says, and it looks like it worked out exceptionally well. It was in Cameco, and it opened lower at 80.40, and then he sold it an hour later at $85, netting $11,440, $4. He says it feels good. He's wondering if this was a trade or a gamble. Now, he talked about how in pre-market uranium pricing, the uranium market had bumped up. It had moved up before the open. And here you can see above the opening, and stocks gap down. And so to me, this is a very smart trade. I think this is not a gamble. I think if you know the space and you're comfortable with it, this is a really nice trade. So more or less, like, just to relate to this in the gold space, because most of you can connect with that very easily, it's like gold rallies 1% in overnight. So gold's about to open up percent. But the stock market got hit with panic selling yesterday, and gold stocks just kind of got sold down, and the gold stocks are set to open lower, gap down today because there's just panic selling and people are selling them. They're actually kind of undervalued. They just got pulled down with the market, but they should be higher. And so when the market opens, they should rip their face off and take off and play catch up. And that's exactly what I think CCJ did. I think this is what you're looking into. So if we actually look at CCJ, we'll just look at the 30-minute chart, this little one over here. More or less, we saw it gap lower in the morning. And then as I talked about how the gap down yesterday usually gets bought back up, which it did in the NASDAQ. The rest of the indices, it bounced back up a little bit, but not fully. But we did see that morning wave of buying. And CCJ rallied all the way up to 85. It was a beautiful 1 hour move. And this is the type of stuff that, you know, this little bit of insight. You time it with a gap down in the stock market, like what I talked about yesterday. And these are, I mean, I know a lot of you do a lot of these trades. So you trade the spikes, you trade the gaps. You guys pull a lot of money out of this market on a weekly basis in some cases. So I would say this was a smart trade. It's also, you know, it's a higher risk trade. It's a stock. You're day trading, so it carries a ton more risk. But overall, that was a pretty smart trade, in my opinion. So the other day I talked about bar charts, this funky chart here. I showed you how to use it, how to read it, how you can trade with it. Very cool tool. I have created my own indicators that I find are equally or actually better, but this is an awesome way to see it. Now, yesterday, just zoom in a bit. Generally, what happens is if this closes below 99, again, if I'll just draw in here real quick, anything over 100, or sorry, 101, anything below 99, usually is a short-term oversold condition. You usually see the market want to have a little bit of a bounce. So it's going to be very interesting. Yesterday, the market sold into an oversold condition based on this indicator. Usually the market has a bounce. Now, this could just be this morning. It could be just today. That's it. This is a very, very short-term momentum indicator. Hence, it's called momentum. And momentum, I generally see as you have day trading, which is you're trading intraday only. Momentum is something that lasts the day or like 3 days. It's just a quick momentum move. It's not quite a swing trade. A swing trade lasts like a week. It's multiple weeks or months. So anyway, it got oversold. I have our own indicator here that I don't always show on here, but let's just pull up the SPY and let's pull up this indicator. So I have this designed to show us when we dip into these oversold market conditions. There's the light green here means, well, the horizontal green means the stock market is in an uptrend. We know when it's in a uptrend or a downtrend. And then we have these little green ones, which tell us when it's just very minor oversold, but it could find a bottom. If you're in an uptrend, anytime it's oversold, you usually see the market bounce. The lime green, the brighter green, is a much more oversold condition. It's a more significant level, meaning we should have a bigger type of bounce in the market. And so with the SPY, you can see we've had multiple of these, which is here and here and here. We have some strength. We got a couple cycles back to back here. Let's just check out the NASDAQ. Let's see if it has actually dipped down. It doesn't have lime green. Well, I wonder if the Russell 2000 does. Russell 2000 actually has a lime green, saying it's a little oversold and overdone here as well. So, and you can see it on our 30-minute chart. These are all based off a bit different indicators, different tools, but they all kind of tell us the same thing in a different way. So that's what I like about this. I look at the market from 3 dimensions, not just price, but price, time, sentiment, and you get a really good picture of all this. So anyways, the reason I'm bringing this up is these usually signal a bounce should happen. And we're starting to see that in pre-market right now, where this upper chart doesn't show it, but Russell 2000's just started to pop. It's 8:39, so we must have maybe had some economic data, a little bit of a pop here. But anyway, we talked about the gap down yesterday being an exhaustion gap. We went from FOMO, everybody feeling like they're missing out, and they don't feel good because they feel like they're missing out on stuff, whether it's precious metals or just missing out on the stock market rally. Now we're in this oversold condition. At the 20-day, we have cycle lows, we have momentum lows, we have all this stuff. So it's going to be interesting to see how this plays out and if the market wants to rip and go higher. Obviously, that's what we want because we are long equities at this point. Anyways, that I think is it for today. I guess I should recap on the markets really quick here. Those were just members' comments. So the markets, stocks this morning are starting to rally. You can see the pop here in the lower, the 10-minute chart at the bottom is 24-hour. You won't see it carry over. Well, the futures we will. We can see it moving here right now in the NASDAQ. The market's just trying to find a bit of a bid this morning. Money's flowing into stocks. It's also flowing into bonds. We have bonds trying to put in a little bit of a bottom here. We have gold and silver both moving up slightly, up about 3/4% or 0.5% or so. Again, when we look at gold and the miners, and they're going up this 5-day moving average. Looks like they're primed and ready to move. If we look at GDX, GDX is moving up in pre-market. It's hit the 5-day. I think we could continue to see this market rally. As I explained in last night's video, if you didn't watch it, I touch on what gold miners do in this phase like they did in 2007. And it means they're set to rally. Just keep in mind, you'll notice there's a better opportunity than gold miners based on how the charts are moving and the fact that gold miners have really popped and started to take off. This is a sign that it's, we're in the late stages here. We're like a couple weeks or a month or so away potentially from gold topping, and that the stock market could actually top any day here. So go back and watch that video from last night if you haven't seen that. Other than that, I think that's about it. Let's take a look at Bitcoin real quick. Bitcoin relatively flat. Anyway, that's it, guys. There's not a whole lot of excitement yet today. We'll see how things unfold. Take care. Bye-bye.